Hello and welcome to the November 2020 edition of the CUNA Economic Update with myself, Jordan Van Ryn, Senior Economist at CUNA. Today I'm just going to give a brief update as to the economy, our forecast for the rest of the year, and what we expect going into the next year, including not only the coronavirus pandemic, but also some thoughts about the current election as well, and what a Biden presidency might mean for the economy. So let's go ahead and get started. As all of you are no doubt aware, the most important factor in the economy right now is the COVID-19 pandemic. This slide shows the rise in daily cases. You can see here the line is the average number of daily cases, and you can see that we've really spiked, and as I record this, are continuing a bit of an upward trend heading right into Thanksgiving and the holiday season. We're now averaging over 150,000 cases a day. This is 2 to 3 times what we had back in the summer when we were averaging about 60,000 cases a day. So very unfortunate news, and first and foremost, of course, our hearts go out to all of the families and people across the country who have lost loved ones or who have been affected by this pandemic. We can see that the death rate rose drastically towards the beginning, and fortunately it has not risen quite as high since. We've stayed below 2,000 deaths per day, but we do see a bit of an upward trend here. Of course, the good news is that treatments have improved, and it looks like there are some very effective vaccines coming out soon. But for any economic forecast, we have to make a few assumptions, and with all of this uncertainty, we are going to assume basically that the next few months are going to be the worst of the pandemic. The combination of the upward trend in the virus, the colder winter months when people will be indoors, COVID fatigue, all of this is going to lead to more business closures, more restrictions, school closures, things of that nature, and all of this will have a negative effect on the economy. We do assume that the vaccine will be available starting sometime in early to mid next year. The latest I've heard, it sounds like people are going to be able to start getting it as early as December or January, but at least that would only be for kind of frontline workers and people that are most at risk, and it likely wouldn't be available for the general public until perhaps the second quarter of next year. And finally, unfortunately, the government stimulus package has been delayed. We do expect another stimulus package probably shortly after Biden takes presidency in late January or early February, but it will be likely much smaller than the original package, perhaps somewhere in the range of 1 to 1.5 trillion, likely including support for business as well as direct payments for households. So we do expect that to help out the economy to some extent starting at the beginning of next year. So let's look at the unemployment rate and labor markets. Just to remind us, we had back in April this huge increase in the unemployment rate to 14.7% officially. The unofficial rate was closer to nearly 20%. This was the highest unemployment rate since the Great Depression. Now it has come down rather quickly, which is the good news. And in October, we had a pretty good report with an official unemployment rate of 6.9%, unofficial 7.2%, so right around 7%. So what do we expect for the rest of the year? Well, you saw the graphs on the pandemic. I don't need to tell you that unfortunately things are going to get bad in the coming months, and that likely means increased restrictions again. We probably won't have things all the way shut down like we did back in April and May when we thought that it would take maybe just a month or two to get control of the virus. But we do think that the unemployment rate will probably level off and maybe even increase a little bit by the end of the year to around 7%. Next year, once we have the vaccines out and everybody much safer and the economy reopening, we expect that unemployment rate to continue to fall to maybe about 6.3% by the end of next year. We have seen some warning signs already, including an increase in unemployment insurance claims through November 14th. So that gives us some reason to think that the unemployment rate might increase here in the coming months. Now, as I've said before, this recession is really quite unique in the sense that housing markets are staying very strong, and the Federal Reserve was very aggressive at lowering both short and long-term interest rates very early on. So you see the federal funds rate has been basically at zero, and we expect that to continue. The Federal Reserve has signaled that that should continue through at least the end of 2023. And they've also done a lot to lower long-term rates as well. So we've seen average 30-year fixed mortgage rates of under 3%. And we think that that's going to start to increase slowly, but will stay relatively low over the next year or two. This has led to a really strong mortgage and housing market. Credit unions are doing a lot of mortgages, and you see that those home values just continue to increase to at least a recent high of $261,000 for the median single-family home. This is much higher than it was even during the housing bubble in the mid-2000s. And you see, it's pretty unique. We're in the middle of this recession, but we had nothing like this downturn that we had during the financial crisis, when a lot of people were underwater in their homes and couldn't use that equity. So that is one thing that's kind of helping the economy. A lot of people still have a lot of housing wealth if they own a home. Of course, there are a lot of people that are renting, and they are in much more difficult situations. For credit unions, mortgages are about half of loan portfolios of credit unions. So when there's a strong housing and mortgage market, that means that generally speaking, credit unions continue to do well, at least the mid-sized to larger credit unions that do a lot of mortgage lending. About a third of credit union loan portfolios are auto loans. And you can see this is what happened to total vehicle sales during this recent recession. Vehicle sales dropped about 50% year over year, which is pretty incredible. But it's rebounded very quickly. This was a pretty fast rebound in vehicle sales, and now we're only down about 3.5% from a year ago. Let's look at loan growth by product for credit unions, and you can see this shows the growth in different credit union loan products. These are credit cards going back from 2014, 2015, 2016, all the way to 2019. And this shows the first 3 quarters through September of 2020 based on NCUA data and then third quarter data from CUNA's credit union monthly estimates. So we don't yet have the NCUA data, but we have a pretty strong estimate from our CUNA survey data that shows that through the first 9 months of the year, credit cards are down about 9%, so a big decrease in credit cards. Other unsecured loans have gone up quite a bit, up about 12%. That's largely due to PPP loans, which fall into this category. You can see new auto loans are way down about 4.4% so far this year. However, used auto loans are up a pretty strong 4.6%. That's already better than last year. And of course, we still have 3 months left in the year. The real bright spot is first mortgage growth. You can see credit unions up 9.1% already this year. Again, that's only through September. So this will probably end up around 11 or 12%, which you can see will be the fastest year of first mortgage growth at credit unions since at least probably the housing bubble prior to the Great Recession. HELOCs and second mortgages are down about 6%, and commercial loans are way up about 19%. Again, a lot of that is due to the PPP lending. So overall, credit union loan growth has been relatively strong. It actually grew a healthy 2% in the third quarter, according to CUNA's monthly estimates, and credit union memberships also grew about 0.7%. So both of those figures are relatively strong for a recession, certainly much better than what we had during the financial crisis. So we expect credit union loan growth of about 6% this year and about 6% next year as well. We think that interest rates are going to continue to stay low. That's really going to continue to boost first mortgage lending at credit unions, a lot of refinancing. And as the economy starts to recover next year, credit unions will start to do some other lending as well, such as more auto loans and credit cards and things of that nature. This is going to also help drive membership growth. So we think membership growth is also going to be a pretty strong about 2.7% this year and about 3% next year. Credit union savings growth we saw grew an incredible 8.3% in the second quarter alone. That was really due to a combination of tax refunds, government stimulus checks, and precautionary savings, which often occurs during recessions. You can see during the last couple of recessions too, a lot of people just saved any money they had. So we had very high savings growth in 2001 and also 2009. But we're likely going to eclipse that by quite a bit this year and end up about 18% an increase in credit union savings growth. And next year, it'll probably fall back to around normal trends, about 8%, although that depends a little bit on the size of the government stimulus package and how much direct stimulus payments we have next year. And of course, when we get a very fast savings growth and relatively slower loan growth, we get a falling loan-to-share ratio, which looks like it's going to end up about 75% this year and fall to about 73.8 next year, way down from where we were last year and the year before when we were up well into the 80s. Now, what do we see in terms of portfolio quality? This has been quite interesting. Actually, the credit union delinquency rate fell to 0.53% in September, according to our monthly estimates. That's pretty incredible because that means that portfolio quality is continuing to improve relative to, say, for example, the end of 2019 when it was at 70 basis points. So what's going on here? Well, it's important to keep in mind that, of course, there was a lot of government stimulus action that really sent people a lot of direct payments, extended unemployment benefits, and all of that helped people stay afloat. We also had stronger than expected loan growth. But more than anything, really, credit unions have been working with their members to modify loans, do all sorts of forbearances and deferments and other ways to help members out. So really, during this time of a lot of loan modifications, these numbers so far throughout the year really understate the true delinquencies and charge-offs that are probably out there. And we're now getting to the point where a lot of those loan modifications are expiring and people are going to start falling behind on their payments. And we expect that delinquency rate to rise to maybe about 1% this year and continue to rise to maybe about 1.1% next year, as, of course, the delinquency rate tends to sort of lag what happens in the economy. And a similar trend with charge-offs as well. That said, you see this is much better than what happened during the financial crisis. And again, that's due to a lot of government action, credit unions working with their members, and also the slightly more temporary nature of this particular recession. Now, credit union earnings is also an interesting case. We saw it actually increase from the first quarter to the second, from 53 basis points to 61 basis points. Some of this is kind of what's happening with loan loss provisions, where they increased a lot at the beginning, and now credit unions are pulling back a little bit on those. But we do expect credit union earnings to continue to fall to about 45 basis points in the third quarter and about 50 basis points for the year. And that's largely due to the very low interest rate environment where credit unions are doing a lot more loans, a lot more mortgages, auto loans with very low interest rates and low interest margins. And that's going to continue into next year as well, where we think there's going to be even more downward pressure on earnings and an ROA of maybe about 35 basis points in 2021. So you can see our full forecast on CUNA.org/economics. And you see these tables here. Maybe just one other thing to point out is this net worth ratio at the bottom. And we do see capital falling from about 11.4% at the end of last year to maybe about 10.2% this year, although the rate in which it is falling is decreasing. So we see it falling to maybe about 9.9% at the end of next year. But at that point, it should level off and start to increase again into 2022 as credit union earnings comes back. All right, just a couple of final points. This is a graph you might have seen before that Mike and I like to show that shows the difference in loan performance and lending between U.S. credit unions and U.S. banks. This is indexed to the start of the Great Recession back in 2007. And what it really shows you is that banks, of course, as we know, really pulled back on their lending. They became a lot more conservative. They held on to capital. And even, 3 years after the recession, they were still down about 3 to 4% in terms of loan growth. Credit unions, on the other hand, they increased lending and continued that upward trend and continued to serve their members. And the really cool thing is that we've been looking at some early data, and we see that the exact same trend is happening during this current COVID-19 recession. We index it again to the start of the COVID-19 crisis, and you see that bank lending again just fell off a cliff. They really pulled back on lending, whereas credit unions have continued to lend and are now even up compared to where we were at the beginning of the crisis. So I think that these are just really cool graphs that illustrate how much you guys are doing in the community to continue to serve your members, even during these really difficult times, and especially relative to banks. Finally, I'll just end by a few thoughts on the potential for the Biden presidency to affect the economy, as a lot of people have been asking us this. Now, generally speaking, if you look at the research, presidents typically don't have a big impact on the economy. You can look at this over many years, but you can see a president will come in and the economy will basically continue on the same trend that it was before. And there are many other things that have a much bigger effect on the economy, like, of course, bursting of the housing bubble or the COVID-19 pandemic, or these big factors that are outside of the president's control. Now, this time could be a bit different for a number of reasons. The biggest reason, of course, is that the main thing harming the economy right now is the coronavirus. And research has shown, too, that it's not so much the lockdowns, but people just afraid of going out to movie theaters or restaurants. So even if you didn't have all the lockdowns, the economy would still be in really bad shape. So there's no contradiction here. These two are not separate. At this point, the virus really is the economy. So getting the virus under control will help get the economy back. And obviously, Biden has focused a lot more on stopping the virus. He's really made that a priority. He's already hired a lot of cabinet members and experts that are very much focused on this. So it seems like Biden might have a bit of an edge there in stopping the virus. A couple of other factors. Some people think, too, that Biden is just going to bring back some normalcy, for better or worse, a lot less uncertainty. And that's just helpful for businesses when they think about when and where to make investments. Biden is a lot more likely to pass further government stimulus and larger stimulus as well. This is something Goldman Sachs pointed out recently that would really help the economy if you had a Biden presidency, because he'd be more likely to pass stimulus, for example, in the range of $1.5 to $2 trillion, whereas Trump and the Republicans seem much less likely. But most economists, generally speaking, agree that the economy really needs additional stimulus at this point. An infrastructure bill is also potentially more likely under a Biden administration, and that can also have strong effects on the economy in terms of direct fiscal support, but also longer run trends in productivity. And so far, Biden's had some really good cabinet picks as well, at least from an economist perspective. For example, Janet Yellen being the new Treasury Secretary, I think, is a fabulous pick. She was, of course, the former Federal Reserve Chairman. She would be the first woman in this position, but she's very well respected in the economics community. She's very smart. She works well with people, and she's really focused, too, on low-income and diverse populations, which I think the economy really needs right now. A lot of people are concerned about, wouldn't Biden put on higher taxes, which would be a drain on the economy? That's possible, but it seems like those taxes are mostly going to be on the wealthy, if they're passed at all, people earning over $400,000 a year. And generally speaking, people in those income brackets and of that wealth, when they have higher taxes, they don't pull back that much on spending. Economists are a lot more concerned when taxes are raised on lower income people, because that directly reduces their spending power. but a lot of wealthy people save a lot of that money anyway. So it's not necessarily a huge drain on the economy when higher income and wealthier people have a slightly higher tax rate. However, of course, all of this is all up in the air because we still don't know whether we're going to have a divided Congress. All of that depends on what happens in Georgia. It seems like more than likely the Democrats will not win both of those seats, which means we would have a divided Congress. And of course, Mitch McConnell can't always block anything that Biden wants to do. So that would really put a drain on the economy if we're not able to do, for example, further stimulus or an infrastructure bill. So that's going to be a big question mark of whether Biden really can work with Mitch McConnell across the aisle and get some of these bills passed. All right, that's it for November's economic update. I wish you all a really happy and wonderful Thanksgiving and hope you all stay safe and well.